How might you deal with all the uncertainty going around today in the market, in the country, in the economy? Well, here to talk with us about that is Beau Kemp from Sensible Money. Beau, welcome.
Hey Bob, thanks again for having me.
Pleasure. Lots to talk about, lots of uncertainty. Where to begin?
Yes, every client meeting right now, uncertainty is definitely the word that comes up. And actually driving into work yesterday, Bloomberg was talking about how much Powell used the word uncertainty in his last meeting. So guess that's just the word of the year so far. It is a difficult it's difficult to try to bring people back in, right, in terms of what's actually happening. And so what I want to go through really is how we go about these conversations. And most of the time I'll start with one, you listen, everyone's concerned, right? Whether some people are overly excited, some people are in fear that the whole country is going to fall apart. And so with that, it's okay, how do we start to approach this? There's two different aspects. We'll have financial and we'll have behavioral. And so from a financial sense, the key thing to take away right now is understanding truly what the media is talking about when they say the market. So every day it's the market's down, the market X percentage points, right? And what they're typically referring to is the NASDAQ or the S&P 500. So what's important to know is you hear that, but you need to figure out what your actual portfolio is invested in. And so with the clients we're working on right now, it's being this year is actually looks good to be diversified. In the past few years, there's a quite a few people that said, nope, I'm going 100% S&P 500. And this year is starting to pay off. And what I mean by that is we can take these clients and their fears and say, look, this is what the media is talking about as the market, but let's take a look at your whole portfolio. Dimensional international cores, so like developed countries, ex-US. As of yesterday, they were up 11% year to date. That's amazing. If that continues, that's going to be a huge year. Now, not guarantee, even if it stayed flat the rest of the year, most people are happy with 11%.
Yeah.
Emerging markets were up 5% year to date as of yesterday. And so those are little slivers internationally that non-US, they actually are performing well. One other aspect I want to talk about is understanding your NASDAQ and your S&P 500. They can start to get overweight with large cap growth equities. And those are typically your tech stocks. They're very volatile right now, depending on what's happening in the news. Whereas if you look at a large cap value fund like at Dimensional Fund Advisors, as of yesterday, I was up 2%. So even in the U.S. large cap sector, there still has been a little bit of a positive yield depending on how you've been invested.
I think before you go on, it's important to raise that point. Oftentimes we focus on the S&P or the Dow or the NASDAQ, and it doesn't really represent someone's portfolio in the aggregate, right? Most people might have whatever 60% in stock and 40% in bonds, and that may be the appropriate time to segue to bonds. No.
Yeah, no, that's perfect. And you're right. That plain vanilla portfolio is 60% stock, 40% bond. Of that 60%, that shouldn't all be S&P 500 or NASDAQ exposure. Typically, that 60% split up of 60 to 70% US stocks, 30 to 40% of international and emerging markets. Very diversified there. As we switch to bonds, again, this is another aspect of how have you built it, right? And, some people might be listening to this of I was 100% S&P 500. Well, that's a complicated strategy now and difficult issue, but you can still work through this. If you have exposure to bonds, and I even lump reserves into this, it's look, I have 12 months of your next cash flow covered, and that's in pure cash. So whatever happens to the market, I don't really care at this point because your lifestyle won't change. It doesn't need to change right now. And I can be confident saying that can continue over the next handful of years because most people that we're working with, they have bond ladders built out that are covering their expenses for the next 5 to 10 years. So it's allowing people to ride the market wave. It goes up and down all the time, but being able to tell a client, look, I have your expenses covered for let's just call it 7 years. The next 7 years, we're fine. As of right now, I know that you're stressed and you're worried, but there's really no need to be at this point. And usually helps. And then also throw out some more returns. But even if you're in bond funds, we don't use bond funds a lot, but if you're in bond funds, it's another sector where diversification's actually been positive this year too. Your AGG, so your investment grade bond index, that was up about 2% as of yesterday, year to date. So there's little aspects that are holding up. When we're reviewing these portfolios, a lot of people, it's not like the returns are good, but they're right around 0 to 1% for the most part from what I'm seeing, that is not doomsday. You know what I mean? So we are not at that point yet.
Yeah. I mean, when you think about like the historical return of a 60-40 portfolio, it's what, around 6 to 8%, give or take, somewhere
Yeah.
around there.
Yeah. Depending on the time period, you'll get your 6 to 8%. And you have to ride the waves though, right? Like there is ups and downs. You don't get that steady return every single year.
Yeah. But I guess which brings me to the notion of you do have ups and downs. You do have corrections. It's part of the normal market life, right?
It is. You see a lot of it right now. A lot of advisors online, they're saying, look, let's zoom out and look at, they'll take the S&P. Look at how many ups and downs there have been. And a correction, that actually happens every couple years. Every 1 to 2 years, you'll see a correction. Just because we're going through right now doesn't mean this year might end up positive. No one knows at this point. Corrections they're normal. They're okay. Even bear markets, those are more extreme. Typically, once the market's down about 20%, they're going to start calling it a bear market. That'll happen every like 4 to 5 years. Again, normal. So if we think about what's happened recently, you've past few years, especially that large cap growth sector, like 20+% returns a couple years in a row. That's not normal either. And so you would expect there to be a somewhat of a slowdown at some point in what we typically refer to as the market.
Yeah. So when I think about the uncertainty, if someone has in place a investment policy statement or retirement policy statement with hope, that's a blueprint that guides them through times like these and maybe removes some of the uncertainty. But then again, we have behavioral finance to deal with too, right?
Yeah, it is. This is where I can build a perfect portfolio, perfect, I'll put in quotes, that lines with your plan, looks beautiful, have a great bond ladder. Then as we start to discuss, I realize, you know what, this actually does not make sense to you. And that's because of the behavioral side. So right now it's emotions are high, I think, for a lot of people in the country. And again, like I started in the beginning, some's really good and some's really bad. Even if you're very high or very low, I'm trying to bring you back towards the middle. The most important thing is like, let's take a step back and breathe, and be honest with yourself. So like what is truly causing this stress and anxiety? At this point it's pretty fair to say like we all have our own algorithm when we hop on our phone, and that's feeding us information that your neighbor might have a complete opposite algorithm. We all can be seeing different things driving this very high or very low emotion. And so if you need to, turn the phone off, right? Like turn the news off, go do things that you can actually enjoy. What I love to hear is clients are telling me that because they're using us, right? Like we're the ones taking on their finances. And so there's, the concept of, then you'll hear people say, well, this time's different, right? In the long run, that this time is different crowd has never been right.
Yeah.
And so like I'm not going to bet on them this time either.
Yeah. Well, you just said something though that made me realize that one of the key benefits of having a financial advisor is that you get to worry about their money so that they don't have to.
Exactly. It is. And it's one of the benefits. It's like, how do you quantify that, right? Because you don't know what moves you'd be making or not, but it's the stress-free, especially think about a retiree, is you worked your whole life to save up these assets. Why finish your life being stressed about those assets? Hire a professional do that for you. And again, I can say, look, your lifestyle has not changed and it won't change for the next 5 to 7 years for sure. So,
And I think the other thing that's important to sort of remember is that uncertainty is sort of the certainty, right? It's not as if we ever live in an environment where things are certain, right? They may seem more volatile now, but things are always uncertain.
exactly. Yeah, I don't know if I can't remember a time where there hasn't been uncertainty. Exactly right. Like I always think back. It's like think about the past 5 years, all the chaos we've gone through, and your portfolio is still up from those 5 years. So it's something to keep in mind.
But we've covered a lot of ground. Anything we missed or just bears reemphasizing?
No, I think the main thing really is just understanding. It's so important to understand how you're actually exposed. And when you hear about the market, just know, I mean, maybe some of you are completely exposed to the Nasdaq or the S&P, and that would be like a completely different discussion. But for the most part, we're all pretty well diversified, And so knowing that it does have an impact to you, but not as much as what you're hearing and seeing. Behaviorally, try not to let your emotions take over. Once you start letting your emotions make decisions for you in the finance world, they tend to go wrong.